So for those of you who still remember the harm issues it had with DTB Bank Kenya, that syndicated loan issues, now the arrangement is a little bit different. For Stanbic Bank, they will have an asset and a liability. An asset for the loan to the government of Uganda through UEDCL, and a liability for the loan that is coming from the European investment firm. The loan, I've been told it's around 7.3% interest rate, which is good. The third, the loan is going to be held by UEDCL, known to the government of Uganda. Now, there is certain dynamics of that, especially when it comes to covenants and everything, and what is now the total loan of the total loans and debt of the government. By it being held by a company, UEDCL, not the government, it means it will sit on the UEDCL books of account. The government is just the guarantor. The loan is for 6 months, 6 years, with a 6 months grace period before the payment starts to go out. Now, so at 17.3%, this is how the loan would look like. At, we know it's a euro, it's a dollar loan, so the government is borrowing close to 190 million. That's the one. The interest rate we have said is 9.3%, 7.3% per year. The loan term is 6 years. We are told they're going to be paying twice a year, which gives the UEDCL grace period to always raise enough money for them to pay. And then it's they would start paying in October, which is a 6 months grace period if the government gets the money in March. So then, which means for those of you who understand the loan terms, this is how it would look like. The scheduled payments, when they should be falling due, and how much the government will be paying every single period. There is the interest rate, there is the principal. So this is the total amount of money the government will be paying every single time, and you can see. Um, and one thing you can see is, so one of the things you end up noticing is it's for 6 months, it's for 6 years. They are paying twice a year. It's starting in October, then and everything else will follow through. So what then you end up noticing is this. What you end up having noticing is this, that these are the total interest payments that the government is going to be making every single period. These are the total payments, you know. So, and I'm highlighting them in their color. What then you end up happening, what you end up seeing, and let me make this bigger for so that people can follow through, is that if our FX is stabilized, I've created a lock-in period of 3750. That means to say, at on average, they're going to be paying the loan back in the US terms, but at an average interest rate of 37, which means on average they're going to be paying around 74 million, and a total of close to 890 million. But even if we are to change this and we put it to 38, right? Whatsoever, that means it comes to just 900 million. So for the period of 6 years, the government is borrowing from a private company, and whoever negotiated it, it's actually a very good loan at a total rate of 900 million for a period of 6 years, right? So what you have to appreciate these are that because the interest rate, our FX has been stable, then you're good to go. The issue becomes is as time progresses, if our FX changes, if this FX ever reaches, let's say 4,000, we have seen it almost reaching there, it means this loan continues to go up and down, up and down. So at this point, it will be close to 950. The question becomes is what would happen if they were to borrow from the local treasury bonds market? So, to explain this, if they were to borrow from the treasury bond market, they would still need to raise. At this point, it's it's 190 million. And if they are to raise that, it means in the local currency right now is around 700 billion. And because it's a 6 year loan, it's a 6 year period time, we have to match time to time. Then you have to say what are the interest rate right now we are seeing in the treasury bond market at. it's around 15%. Now, I'm also going to make another assumption that let's assume this is an infrastructure bond of which they're not going to pay tax, but that's a stretch. They don't have the framework for it. What then ends up happening is that means at if it's to mature in let's say 2031, then you end up having a total of, because we have to match the period, the 6 period, the same time as the loan they are getting from the Stanbic Bank, then you end up having that the government is to borrow 703 million, and at 15% average interest rate right now, they would have to be paying around 52 billion, apologies, every single 6 months, and then have to pay back around say, that principal at the end of the 3 year period, at the end of the 6 year period. That is a total of, literally to say, a sum of 1.38 billion, which we can ramp it up and say it's one for I'll do it this way. Let's wrap it to 1.4 billion, so, not 1.4 trillion, so that means to them they had a decision to make, which you'd think it's a better, because if they are to borrow from a treasury bond market, they are going to have to end up incurring almost 1.4 trillion in a space of 6 years to just finance the UMEME buyout. By them choosing to borrow from a private investment firm in Europe and getting a European euro dollar loan, then it ends up being maximum a trillion. Because you have to think about it this way: this being a dollar loan, for as long as our interest rates remain within 3750, which I've created, it's just a total of 890. But if it ever goes to 4000, which is possible in the next in the next 6 years, their maximum is 950 billion, which is already half. They are saving close to 500 billion in interest, loan, and expenses. So to them, that's a better financially viable decision. Even if this interest rate for this loan, for this European dollar loan, it will match the interest rate they would have to pay in the UGX equivalent. That FX impact would have to be, let's say, 4,005. Even 4,500 wouldn't make it that way. Actually, that FX must be maybe close to like 6,000. I don't know if it would make it reach there. Yes, close to 6,000, which is close to impossible. It means we have to lose our value 10 times in the next 5 6 years for us to see this FX loan, this euro loan, be more expensive than the treasury bond. On this one, the government made a better investment decision, financing decision. So that is what might be guided them to take that approach.